We'll start with a new topic called capital budgeting. Under this topic, we'll study mainly what is the meaning of capital budgeting, how many types of capital investment decisions can be made, what are the project evaluation techniques, and finally something about capital rationing and decision making under risk. So let us try to understand the meaning of capital budgeting. As you know, capital budgeting means planning for capital expenditure, that is purchase of capital assets by the entity. And capital budgeting decision means whether the company or the entity should invest in long-term projects or not. Long-term projects include setting up of a factory or installing new machinery or creating additional capacities to manufacture a part which at present may be purchased from outside, and so on. So all kinds of decisions can be taken under capital budgeting decisions. So it is an important and crucial decision for business because of many reasons. Some of the important reasons for attaching lot of importance to capital budgeting are: one, there is a substantial amount of expenditure involved in the case of capital budgeting decisions. Therefore, one needs to be very careful in trying to invest in a particular project or not. Second is a long time period. Capital budgeting decisions fructify for after a long time, and once the decision is taken, it becomes irreversible. That means irreversibility of the decision also is a very important consideration for the capital expenditure decision being very, very important. And normally it is a complex decision because we will be basing our decision on future cash flows which are likely to accrue to the entity after the project is completed, and therefore a number of factors need to be kept in mind before a decision is arrived at as to whether to accept a particular project or not, or whether to choose one project over the other project. So based on the types of projects we undertake, they can be classified into various ways. So on the basis of the firm's existence, we can classify them as replacement and modernization decisions, and expansion decisions, and diversification decisions. So there is slight difference in all of these decisions. Replacement decision is particularly replacing a particular item of machinery or replacing a particular item of shed to suit the needs of the current business. Whereas modernization decision involves modernizing the equipments in order to improve technology. For example, we may try to replace semi-automatic machines with fully automatic machines, or you can bring in new machinery having new technology which has come into place. Such decisions are known as modernization decisions. And then you have expansion decisions. Expansion means expanding the capacity of the plant. That means you may need to install more machinery, or you may need to have more buildings in order to increase the capacity of the plant, or in the case of a service unit, you want to add some more facilities so that the number of customers can be increased. Such decisions are known as expansion decisions. Then we have diversification decisions. To diversify means to get into some other activity, it could be related activity or it could be totally unrelated activity. Normally many businesses want to diversify because diversification helps in reducing the risk attached. Therefore, you see many companies having multi-product in their portfolio, because if something happens to one product, they can compensate that by having more profits or stable profits in other products. So diversification decisions are taken on a routine basis by many firms, and this is also a type of capital budgeting decision. Similarly, on the basis of the decision situation, we can classify capital budgeting decisions into various decisions such as mutually exclusive decisions, accept reject decisions, and contingent decisions. Mutually exclusive decisions means when one particular project is accepted, the other project cannot be accepted. That is mutually exclusive decisions. In many cases, what we have to decide is whether to go in for a particular thing or for a different item. For example, a company may be trying to adopt one particular project and one method of manufacture over the other method of manufacture. For example, in the case of a power plant, they can decide whether to go on the basis of coal or on the basis of nuclear energy. So, here if one is accepted, the other will be automatically rejected. So, such decisions are known as mutually exclusive decisions. That means, both decisions cannot be simultaneously accepted. The accept reject decisions are based on such matters that either you accept the decision or reject the decision. There is no question of acceptance in half. It can be accepted in totality or rejected in totality. For example, a company may decide whether to outsource a particular product or to manufacture in-house. So, if one is accepted, that means if the company accepts to outsource it, then it cannot be manufactured in-house. That means the other proposal is rejected. So, accept reject decisions also can be taken under capital budgeting decisions. Then we have contingent decisions. Contingent decisions, as the name suggests, are contingent upon something happening or not happening. For example, you may have to think of situations where if something happens, you may have to replace the existing setup with another new setup. That such decisions are known as contingent decisions. For example, if you are not able to procure raw material from a particular place, you may have to think of procuring material from another place or having another use for the machinery or the fixed assets installed. Such decisions are known as contingent decisions. Now, we will talk something about the project evaluation techniques. Once having identified a number of projects which an entity or a company can take up, then they have to decide as to what projects can be taken up, whether one project can be taken up or a number of projects can be taken up, and what is the basis of choosing one project over the other, or what is the process of choosing a few projects over other projects. So, a number of techniques have been developed to take a decision, and the most important techniques for project evaluation are: one is called the payback period, second is the payback reciprocal, third is the accounting or average rate of return method, also referred to as ARR, and third is the net present value method, also commonly referred to as NPV method. This is of course the most important method commonly used by most of the entities in evaluating capital budgeting projects. And the next one is called the desirability factor or the profitability index, and the last one is called the internal rate of return, also known as IRR method. IRR method also is used in certain cases. It has certain advantages for the NPV method and certain disadvantages. We will take up each one of them and try to find out what is the method, what are the advantages and what are the disadvantages of each of these methods. Coming to payback period, as the name suggests, what the entity wants to know is in what time they are going to get back the money which they have invested. So, it is one of the simplest methods to calculate the period within which the entire cost of a project would be completely recovered. Suppose you have invested 1 lakh of rupees, you would like to know during which time you will be able to recover the entire 1 lakh. And the sooner you are able to recover your investment, the better is the project. So, wherever the payback period is shorter, then such a project is accepted over another project where the payback period is more. So, what you have to do is we have to find out what are the total cash outflows, that is the amount of investment needed for the project, maybe at the beginning or during the course of the project, and what are the total cash inflows from the project. That means what cash inflows can the project accumulate over its useful life. If the useful life for the project is say 5 years, we have to find out how much money is going to come back to you within a period of 5 years. So, here it is very simple to calculate, that is one of the biggest advantages of this method. And second is the decision becomes easier, the shorter the payback period, the acceptance is there. If the longer the payback period, then such a project will not be accepted. But what are the disadvantages of such a period? Mainly what it does is that it adds up all the cash flows which accrue to the entity over a period of time. So, as we have seen in the concept of time value of money, we cannot simply add all the cash flows occurring at different points in time, because money has got time value. So, this does not take into account time value of money. That is one of the biggest drawbacks of the payback period, and therefore it will not give you an idea as to whether you will be able to recover the money. So, in such case what happens, even if you are able to recover the money, it may not be equal to the present value of the investment you have made. The present values of the cash flows may not equal, though technically the total cash flows may be more than what you have invested. Second disadvantage of this method is that it does not take into account cash flows which occur after the payback period is over. For example, let us say there are two projects where you are getting cash flows. In the first case, you are recovering all the cash investment within, let us say, 2.5 years, and thereafter it gives you cash flows for another 2 years. And there is another project which has got a useful life of 8 years, which gives back the reinvestment after a period of 3 years. And since you have accepted the one with a payback period of 2.5 years, you are ignoring the other project which has got a payback period of 3 years, but which will generate cash flows for you for a number of years, which is more than the number of years of the project A. Therefore, we are ignoring all the cash flows which occur to the entity after the payback period is over. So, if you add up all the cash flows, perhaps the other project will be giving you more cash flows in total than the one which you have accepted. This is one of the disadvantages of the payback period. Therefore, these days what they have done, they have introduced another method known as the discounted payback period. So, here they try to remove the disadvantage of the payback period by taking the time value of money also, by discounting the cash flows by a predetermined rate, and such a method is known as the discounted payback period. So, there we are trying to compare the cash outflows with the discounted cash inflows, that is the present value of the cash inflows, and wherever you are able to recover it at a faster rate, that is where the payback period is smaller, then that project is accepted. Then the next method is called the payback reciprocal. As the name suggests, it is the reciprocal of the payback period. So, what we do is, we take the average annual cash flows and divide it by the initial investment. For example, let us say your initial investment is 1 lakh rupees, and over a period of 5 years you have got total cash inflows of 2 lakhs. Then payback reciprocal will be 2 divided by 1. That means you are recovering 2 times the original investment in a period of 5 years. So, if you take another project where the payback reciprocal, let us say, is 1.8, that means you are getting back 1.8 times your initial investment. So, the decision becomes easier for you to accept or not to accept a particular project. So, obviously, you will accept a project which has got a higher payback reciprocal. That means, if you are able to recover more money than your original investment, naturally you would accept that project. So, payback reciprocal is exactly the inverse of the payback period. So, in the case of payback period, we accept the project with a smaller payback period, whereas in the case of a payback reciprocal, we accept a project which has got a higher figure of the payback reciprocal, because that denotes the number of times of the cash flows you will be recovering compared to the initial investment. Then we come to the third method known as the accounting or the average rate of return method, that is also called the ARR. So, as the name suggests, it is an accounting profit or the rate of return which we are considering here. So, accounting rate means the average annual yield on the project. So, what we do is we take the profit after tax and depreciation as a total percentage of investment is concerned. So, the rate of return is calculated as total profit into 100 divided by net investments in the project. So, that will give you an idea as to what is the percentage of the initial investment which you are recovering on annually, that is in a year. So, the higher this figure, naturally the project will be preferred over the one which has got a lower figure. So, the accounting rate of return is another very simple method, but the disadvantage in this case, like in the case of a payback period, is that this also does not take into account the time value of money, because what we are taking is only the total profit, and to that we are adding depreciation, and based on that we are trying to determine whether a project can be accepted or not. So, whatever disadvantages we had in the case of payback period equally apply to this method of accounting. And the fourth method is one of the most important methods, which is commonly used in most of the capital budgeting decisions. It is known as the net present value method, also called the NPV method. As the name suggests, what we have to find out in this method is the net present value, that is the present value of the project. For that purpose, what you have to do is you have to find out the present value of the cash outflows and also the present value of the cash inflows, and then net it out. So, if the net present value of the cash inflows is greater than the present value of the cash outflows, then you will have a positive NPV. So, whenever the NPV is positive, we accept the project. If the NPV is negative, we reject the proposal. So, here what we do is we discount the cash flows as they occur during different time and try to arrive at the present value, and the discounting is done at a rate which has to be determined. Normally, that is the rate at which you would like to have a return on your investment. So, once this is done, we will be able to take a decision and compare a project with another project, or independently each project can be decided upon. Wherever a project has got a positive NPV, we always accept that project. If a project has got a negative NPV, that means if it is less than 0, we will straight away reject it, because you are not going to recover your investment on that. So, in the case of comparison also between two proposals or more than two proposals, you always accept those proposals which have positive NPV, and among them we accept a proposal which has got a greater NPV than the one which has got a lesser NPV. And what are the advantages of this method? The major advantage of this method, as we have seen, is it takes into account the time value of money. That means all the cash flows which are occurring at different points of time are discounted, and we try to compare only the present values and not the cash flows as they occur at different points in time. That is one of the biggest advantages of this method. But the only disadvantage is that in order to calculate the present value of the cash flows, we need to decide on the discount factor. We need to decide on the discount rate of return. That is, at what rate the cash flows have to be discounted, and that is a very subjective thing. So, if you change the discount rate, then the NPV can be changed and your decision can change. To that extent, it is not totally reliable. But these days, there are a lot of ways of trying to objectively fix the discount rate based on what is the expected rate of return from a particular project, depending on the risk factors involved in that particular project. Of course, higher the risk, higher is the expectation of return. So, based on that, objectively we can try to fix a particular rate of return which is required from that project, and that is used as a discount rate in order to convert the cash flows to the present values. For this purpose, what we have to do is, since we have got different cash flows occurring at different points of time, and cash flows will not be same, as we have seen in our study, that whenever single uneven cash flows are there, we need to individually convert each one of the cash flows into present values, then add up everything. So, in this case also, you have any number of cash flows depending on the useful life of the project. For example, if the project has a useful life of 5 years, so there will be 5 cash flows occurring to the entity over a period of 5 years, and in addition to that, at the end of the project you have certain scrap value which accrues to the entity on the sale of the assets. So, that is also another cash flow which also needs to be converted to present value. So, if you remember the formula for converting a single cash flow to the present value, we can apply the same thing and try to arrive at the NPV. So, in this case, NPV is given by the present values of all the cash inflows, which are given by cash inflow for year 0 divided by 1 plus k raised to 0. So, in this case, year 0 there will be only cash outflow. So, that part will be negative, and from the first year onwards you will have cash flow inflow for year 1 divided by 1 plus k raised to 1 and so on up to the nth year, that will be Cfn divided by 1 plus k raised to n. So, where n can be any number of years depending on the useful life of the project. Normally, it can vary from 3 years to even 20, 30 years. So, CFO is called the cash outflow at time 0. Only thing is, here we have simplified. Cash outflows can be at time 0 or it can be during the course of the project also, because in certain projects it can be after 1 year, after 2 years also, in which case we have to take the cash outflows also for all the 3 years and cash inflows for the useful life of the project. And K is the discount rate which we were discussing earlier, that has to be selected after a careful study of the project which is being considered and the risk involved in that, and N is called the useful life of the project. So, this is how this is calculated, and once this is calculated, then you have to take a decision, and decision is based on what we call the acceptance rule. In the case of an NPV technique, the acceptance rule is simple, as we have already learned, that a project can be accepted if NPV is positive, that is if NPV is greater than 0, and it is rejected if it is negative, that if NPV is less than 0. But if NPV is exactly 0, then project may be accepted, as it implies that it generates the same amount of cash inflows as there are cash outflows. So, there we can take a decision whether to reject or not reject. Normally it is accepted unless the NPV is negative. Now, we come to the next technique of capital budgeting, known as the desirability factor, also called the profitability index, also referred to as PI technique, that refers to profitability index. So, here what we have done is, whenever we want to compare different proposals, it is easier to convert them into a scale of 1 to 3 or 1 to 5 or 1 to 10, so that we know that if it is greater or less, then the acceptance can become easier. So, the same thing which we are doing in the case of NPV project is extended further, and then we try to arrive at the desirability factor. Instead of trying to reduce the cash outflows from the cash inflows, what we do here is we take the cash inflows and divide it by the cash outflows and try to arrive at a number, and obviously if that number is greater, then it is a better proposition, because then the cash inflows will be greater than the cash outflows. So, here what we do is, we first work out the present values of all the cash inflows and then take the present value of the cash outflows, divide the first by the second, and if it is greater than 1, it means the present value of all the cash inflows is greater than the present value of all the cash outflows. Then obviously such a project is accepted. If it is less than 1, it means that the present value of the cash inflows are less than the present value of the cash outflows, and the project will be rejected. And between two projects, naturally, the greater the value of the desirability factor or the profitability index, the better is the acceptance. So, between two projects, with the desirability factor of 1.2 in one case and 1.5 in another case, naturally you would accept a project which has got a higher profitability index, that is, we will accept the project with 1.5 profitability index, because there it means that the PV of the cash inflows is at least 1.5 times the PV of the cash outflows. So, that method also takes into account the time value of money, because what we are taking is the present values of the cash inflows and the cash outflows. Then we come to the last of the techniques of capital budgeting, known as the internal rate of return, also referred to as the IRR method. IRR is the rate of return at which the sum total of the discounted cash inflows equals to discounted cash outflows. So, here instead of trying to calculate the present values, we would like to calculate the discount rate at which the present value of the cash outflows equals the present value of the cash inflows. So, as you have seen in the case of NPV, we wanted to find out the present values and find out what is the net present value by assuming a particular discount rate based on the risk factors associated with the project. Here, instead of trying to fix the discount rate, we try to choose that discount rate which equals the present value of the cash inflows to the present value of the cash outflows. So, that means it is that return which is generated by the project. Therefore, it is called the internal rate of return. So, it is the return which the project generates in such a way that whatever cash flows are there, they will equal the cash outflows. And since present values can be calculated only if you know the rate of return or the discount rate, in this case, since the discount rate is not known, it is not possible to calculate the present values. So, it becomes a trial and error method. So, what we have to do in this case is, we have to choose different rates and try to calculate the present values of the cash inflows and the cash outflows and try to match them. And if they do not exactly match, then we have to vary the discount rate and go on until we reach a stage where both are equal to one another. And that rate which we have used for calculating the present values becomes the internal rate of return. So, the formula of course will be simple, because it is a trial and error. It is exactly like the NPV method. Only thing is, the method has to be repeated a number of times, so that the present values equal each other at a particular rate of interest or rate of discount. So, in this case, what it means is, we are trying to calculate the rate at which the NPV becomes exactly 0. So, that is the rate which the project is giving. So, what are the advantages of this method? One advantage is that we know exactly how much the return the project is generating. That is one of the advantages. The biggest disadvantage of course is the cumbersomeness of the calculation. It is a tedious and complex calculation, because it is only by trial and error that we can calculate this method. And one of the drawbacks of this method also is that we take into account the fact that whatever cash flows are generated during the intermediate years are again employed by the project at the same rate of return, which is not normally realistic. For example, if a project makes profits in the first year, those profits will be again invested in a project. It could be in the same project, or they could be invested in another project, but to assume that they will also start earning the same rate of return is not realistic. So, to that extent, the IRR method suffers from this drawback, but by and large this is also one of the common methods employed by most of the entities in order to evaluate their capital budgeting decisions. So, now we will come to another concept under capital budgeting, that is what we call capital rationing. As we know, capital is not available in plenty. So, entities will have to work under a situation where capital is scarce, capital is not available in whatever projects they want to invest. They have a limited amount of capital, or they can raise only a limited amount of capital, and based on the capital at their disposal, they have to decide in which projects they have to invest the money. So, this is a situation of capital budgeting. For example, you may have several projects, and according to NPV method, you find that a particular project has got a greater NPV, so you want to accept it, but the investment there may be such that it is in excess of the capital available with the entity. So, in such a situation, you have to make a decision as to what projects can be accepted, or what combination of projects can be accepted, given the condition that the capital is scarce. So, availability of capital is limited. So, such a situation is known as capital rationing, and mostly in developing countries, particularly countries like India, this is the normal situation with most of the entities. So, this is a very realistic assumption that most of the entities always have a situation of capital rationing. So, in this case, what they do is, they have to accept all investment projects with positive NPV. First of all, they have to select those projects which have only positive NPV, and once the projects are selected which have got positive NPV, then we have to choose a combination of those projects such that the capital requirement of those projects is equal to whatever capital is available with the entity. So, if a particular project, though it has got a higher NPV, may have to be rejected because the capital availability is not there, or it can be postponed. So, there again situations can be a project can be taken up in stages, and in some cases projects cannot be taken up in stages because we have to invest the entire amount at one go, in which case some projects may have to be rejected, or some cases some projects may have to be extended further. That means they have to be implemented over a period of time depending on the availability of capital. So, this capital rationing, what are the reasons for capital rationing? They can be experienced due to external factors, mainly imperfections in the capital markets attributable to non-availability of market information, investor attitude and so on. Normally what happens, each entity has to raise capital from the capital markets, and because the entity may not be well known or the investors may not have the correct information about the company may not be able to raise the required kind of capital from the market. Some companies may be able to raise if they have a very good name, but many companies, because of lack of information in the market or because of lack of availability of the funds with the investors, or maybe due to the attitude of the investors, the companies may not be able to raise capital. And secondly, the internal capital rationing also could be there. That is, it is a capital rationing set by the entity itself. The entity itself decides that they will not raise additional debt. They would not like to go borrow money. They would like to only take up projects with whatever funds are available at their disposal by means of profits which they have generated. So, this is called a self-imposed rationing. That means there is a restriction put by the management itself. So, in this case, there could be another way of rationing. For example, a company may have to decide that they will flow back only certain percentage of profits because they have to distribute dividends to the investors. So, if investor sentiment has to be kept up, they are required to distribute dividends of a particular amount. So, only so much amount is available for flow back of profits. So, all these types of rationing may come into play, and because of this, managements will have to decide the quantum of capital available with them, and based on that they have to take a decision as to whether accept certain projects or reject certain projects, or accept only a certain combination of projects, even though other projects which are rejected may have a higher NPV. So, here we can summarize capital rationing in that the selection of a project under capital rationing involves the following. One is identification of the projects that can be accepted by using evaluation techniques as discussed, that is either the NPV method or the IRR method or any of the other methods, and then selection of the combination of projects. Once you have identified the projects which have to be accepted, then you have to choose a combination. So, normally what happens, it is desirable to accept several small investment proposals than a few large ones for fuller utilization of the budgeted amount. For example, let us say you have got a capital available of only 10 lakhs and you have one project where you have to invest 9 lakhs and you have a certain NPV for that project, or you may have a number of proposals of 2 lakhs each where the NPV taken together will be more than the NPV which you get from that one project of 9 lakhs. So, it is better to accept, let us say 5 proposals of 2 lakhs each, which will give you a combined higher NPV than one proposal of 9 lakhs. So, in such cases, it means that the company is foregoing some opportunities, but taking up some other smaller opportunities. So, it is a question of give and take. Sometimes it may not lead to optimum results because of the restriction you have on capital. You may not be able to maximize the wealth of the shareholders to the extent desired, but there is no other go for the company but to accept the restriction of capital which it has placed itself on or which is there because of external factors. Now, we will come to another very important concept known as decision making under risk, and before that we have to know that in real life there are different situations where we have to take decisions. Normally they are classified into 4 categories. One is decision making under certainty, that means everything is known to you and you have to make a decision. For example, you want to invest money in a bank and you know that the bank gives you 8% return. So, everything is certain, bank giving you 8% is certain, and you are investing 1 lakh rupees in the bank also is certain. So, decision becomes easier. So, wherever there is certainty, decisions are easier. Then you can decide whether to put the money in the bank or in the post office, depending on which gives you a higher return. So, second situation of decision making is decision making under uncertainty. That means nothing is certain and you have to take a decision. That is the most difficult choice given to you, that nothing is certain and you have to make a decision. This is also possible in most of the real life situations. And a third situation is known as decision making under risk. So, here it is slightly different from uncertainty. Risk and uncertainty, though appear to be same, they are slightly different, in the sense that in the case of a risk, you have some kind of idea as to what may happen. You may not exactly know what is going to happen, but you have some kind of idea, that is, you know probability of a particular thing happening or not happening. For example, let us take the example of monsoons. In the case of India, we know that monsoons, many agriculturists depend on the monsoon. So, if a farmer has to take a decision whether to sow paddy or some other crop which requires less rainfall, he has to make a decision under risk. What is the risk here? The risk is that the monsoons may fail, monsoons may be just normal, monsoons may be above normal also. He would expect monsoons to be above normal if he wants to raise the paddy crop. So, but it is not entirely uncertain. He has got some kind of data, past data to fall back upon, so that he knows the probability of monsoons being normal or above normal is a certain probability, and based on that he can take a decision. So, in the case of decision making under risk, we always have situations where we know what is likely to happen and what is the probability of that thing happening, whereas in the case of uncertainty, we do not know exactly what may happen, anything may happen, that is decision making under uncertainty. And lastly, we have decision making under conflict. So, there may be a conflicting situation and we have to make a decision because that conflict cannot be resolved sooner. So, even if the conflict cannot be resolved, you have to take a decision. So, under all four situations, we have decision making to be made, and therefore, we have to expect this. So, for your purpose, of course, we will be only discussing decision making under risk. So, in this case, there are some different approaches where we can try to make a decision even if there is some kind of risk. So, these are known as expected monetary value approach, that is EMV. Second is the risk adjusted discount rate approach. Third is called the sensitivity analysis. So, considering the first one, that is the expected monetary value. So, as I said, no, this uses the theory of probability. That means they would like to find out what are the probabilities of certain events happening. And for this purpose, we have to understand the following terms. One is actions. These are the acts which the management performs by choosing a particular action amongst alternatives. For example, like we have said, no, let us take the first example of an investor who has got an amount of 10 lakh rupees to be invested. His alternatives, let us say, are four. One is he can invest in real estate, he can invest in gold, he can invest in the stock market, or he can invest it in a bank. So, what option he has to choose? And this option, this action of the investor is called actions. Then events. Events, these are the various states of nature which influence the payoff of a specific action taken. Management has no choice about a particular event. That is, event is what can happen to the economy. That is an event. Economy can grow very high, there can be moderate growth, or there can be a recession in the economy. So, these are the events which are the beyond the control of the management, in this case the particular investor. So, if the event so happens that the economy grows faster, then it makes sense for him to put money in a stock market, because the stock market will boom and his returns will be much better. Whereas, if the economy hits a recession, then stock market will not yield him much, maybe even gold and real estate also may not yield him much, then it makes sense for him to put money in a bank. So, this is an event which is beyond the control of the management or the entity, and payoff is what he is going to get based on his action and also based on what event is likely to happen. So, in this case, as I said, if the stock market goes up and if he has decided to put money in the stock market, then his return will be more than let us say 20%. So, that will be called the payoff. So, but if you have decided to put the money in the bank, it will still be 10%, whether or not the economy goes up or not. So, the payoffs will be related to the event which is happening and also the action taken by the management or the entity. So, based on that, they have to take decisions. So, what they do is they try to find out the probability of each of the events happening. This is of course done based on the past data, and then try to fix off the payoffs for each of the actions under different events, under different scenarios, and then you have to arrive at the expected monetary value by multiplying the probability with the payoff of that particular event to give you the total expected monetary value under that particular event. For example, if you calculate that the economy going into a recession is, let us say 30%, economy doing very well is 30%, and economy doing normally is 40%. The total comes to 100%. Normally, probabilities are converted into decimals. So, this will become 0.3, 0.3 and 0.4. So, we have 3 probabilities all adding up to 1, and the payoffs, let us say, could be 8% on bank deposits. In all 3 situations, payoffs will be similar, whereas in the case of stock market, payoff, if the economy does well, let us take it as 20%. If it is normal, let us take it as 15%. If it is recession, then we take it as minus 5%. So, there what we have to do is we have to multiply these payoffs with the probabilities and then arrive at the total. And once you have arrived at, you take into account the expected monetary value under each of the 4 situations you have, and then wherever the expected monetary value is more, you choose that particular course of action. That is how decisions are taken under risk by the concept of expected monetary value. Now, we come to the next technique of decision making under risk, known as the risk adjusted discount rate approach. It is also known as RADR approach. So, what here we do is we try to adjust the discount rate by the risk which is taken in the project. So, normally we have seen in the case of capital budgeting technique that we choose the discount rate. Here we would like to add another value to the discount rate to take care of the extra risk on account of the risk and uncertainty involved in that particular decision. So, what happens is an investor would always like to have a little more return on a risky venture than when he is putting money in a less risky venture. So, the greater the risk involved in an investment, the greater is the need for higher expected return. So, this is the basis on which this RADR approach is based. So, here what we do is we try to find out the net present value by using the higher discount rate. So, if that is positive, that means if the project is going to yield you a higher NPV even after taking into account a higher discount rate, then that project is accepted. So, what we do here is the method is simple. First of all, you have to decide what is the risk premium which is to be added to the risk free rate of return. Risk free rate of return is the return which you will get if you invest your money in a investment which has no risk. Normally, such investments are in the form of government securities. If you invest money in the government securities, there is no risk, and if suppose government pays you 8%, that 8% is known as the risk free rate of return. Suppose you want to invest in the stock market. So, there the risk is high. So, you may add 5% on the 8%. So, that 5% is called the risk premium. That means you would like to have extra return for the extra risk you are taking. Suppose you want to put in a highly risky venture. You want to decide on a capital budgeting project which has got very high risk. Then the risk premium can be even more. And based on that, you find the total return we expect. So, the total return which you expect from a risky project will be the risk free rate of return plus the risk premium relevant for that particular risk which you are undertaking. Then once you do that, you discount all the cash flows occurring from that project by the higher discount rate, and then we decide whether there is a positive NPV or not. If the positive NPV is there, then project can be accepted. Then we come to the third technique of decision making under risk, known as sensitivity analysis. In this case, what we try to is, we want to find out how sensitive are the profits or the cash flows to different things happening. So, because in the case of probability, what we have done, we know that the probability of a particular thing happening is so much based on the past data. But what happens if there are small changes in what you have assumed, then how it is going to affect the cash flows, how it is going to affect your total NPV or the IRR. So, such a study is known as the sensitivity analysis. If suppose, for example, the raw material prices go up by 5%, what effect it will have on the NPV, we have to find out. That means, we have to find out the cash inflows on the assumption that raw material prices are going up, but all other factors remain the same. Based on that, you find the NPV. To what extent NPV changes, whether it turns negative or whether it becomes less positive, that you have to find out. If it becomes, if the change in NPV is much faster than the change in the price of raw material, that means this particular project is highly sensitive to the change in the price of raw material. So, sensitivity of each factor involved in that project has to be determined, and then you have to take a decision whether such kind of high sensitivity you can live with it, whether anything can be done about that. So, if the impact of such a change is known, then we can take independently a decision as to whether such a project is acceptable or not. So, sensitivity analysis is a very important analysis undertaken in order to find out as to what are the factors which impact on a particular project more and those factors which impact less. So, in the case of those factors which are impacting highly on the project, we have to again consider whether it is worth taking up this project, whether there is any probability of the change of a particular event to that extent where it is going to affect the entire NPV of the project. So, these three important approaches are used for making decisions under risk.